Financial inclusion definition and benefits. Could you purchase a home or a car without getting a loan? Not many of us would. What about not having insurance and paying for emergency medical care? Same narrative. It is nearly hard for people without access to financial institutions to save enough money for expenses, much less accumulate the kind of wealth that they can leave for their children, says Jed Anthony Ariens. Globally, financial inclusion is a significant problem. In emerging economies, formal savings and credit are inaccessible to around 1.5 billion individuals. They rely on unofficial lenders and personal networks for loans, pay for everything with cash, and lack a safe means to store and invest their money. Furthermore, just because the US is one of the richest nations in the world doesn't imply that conditions there are any better. Just half of 25,000 Americans surveyed recently said they could not support themselves for longer than 2 months if they lost their work. Furthermore, millions of Americans are underbanked, which means that even while you have a bank account, you still rely on services like money orders, check cashing, and payday loans, which are more expensive to use than credit cards or conventional loans, to manage your finances. Jed Anthony Ariens says opening a bank account, making a payment, or applying for a loan are only a few aspects of financial inclusion. It serves as a tool as well. The gap that exists between economic opportunity and achievement can be closed through financial inclusion. We have a significant chance right now to reverse centuries of marginalization and pave the way for general economic expansion. Continue reading to find out more about financial inclusion and its significance. How may mobile service providers contribute to greater global financial inclusion? Mobile providers have a great chance to increase financial inclusion for the billions of unbanked people and generate enormous value by entering a sizable and mostly unexplored market, especially in emerging nations. According to Jed Anthony Ariens' 2018 projections, digital finance may potentially reach over 1.6 billion additional retail consumers in emerging nations and contribute $2.1 trillion to the volume of loans given to individuals and enterprises. The providers of these goods might potentially see a $4.2 trillion boost to their balance sheets, according to a Jed Anthony Ariens forecast at the time. Even if this was a few years ago, there is still a big chance because, as per the World Bank's 2021 Global Findex report, up to 38% of people in developing nations do not have access to banking. However, there are a lot of unknowns in a market this size that are unexplored. To better understand how digital payment providers may seize opportunities and advance financial inclusion, McKinsey examined both public and proprietary data from Southeast Asia, East Africa, and West Africa in 2018. The results were unambiguous. Although there was a lot of potential, providers needed to make large long-term investments in new types of relationships. What is open financial data, and how might it enhance the inclusion of financial services globally? Financial inclusion is greatly aided by the availability of open financial data, says Jed Anthony Ariens. The capacity to communicate financial data through a digital ecosystem with little effort or manual intervention is referred to as open financial data. Widespread adoption of open data platforms may boost GDP by as much as 5% in India and up to 1.5% in the US, the UK, and the EU by 2030. Customers of small and medium-sized businesses, individuals, and financial institutions can all gain from the availability of open financial data. Benefits for customers include the following: improved availability of financial services. Customers who might not otherwise be able to purchase and utilize financial services can do so thanks to open data sharing. For instance,